Alrighty, hello everyone. This should be the slide that you're gonna like the most, okay? This is the lecture you've all been waiting for. This has no equations and no T-bills. It's gonna talk about behavioral biases, okay? And this, I think, is probably the most important out of the immediate value you can take, even if you start with zero knowledge in finance. Knowing about these behavioral biases is important because you're going to meet them everywhere. They are inside all of us as a default. It takes some training to overcome this. It's like becoming a soldier. You know, when you get rid of these, then you're a soldier. You can do what you're expected. Behavioral biases. Okay. Let's start with technical analysis. Here you should be really excited, okay, because there's an extra filter point here for you. There's another 0.25%, 0.25 points to your final grade if you get this right. Okay, I'm going to show you some graphs. See, in each one there's a blue line, there's a black line and a red line, and you need to draw on your intuition, or if any of you know anything about technical analysis and charts, then you need to choose the either the black or the red. Now these are actual stock indexes from these periods. Okay, it's almost 2 years, and now we're well into 2018. So I know how the future unfolded, and you can have a look at how these charts look like and tell me which one you think will overperform in 2017 and 18, and I will reveal them to you, and whoever got it right will get the quarter of the point. If you get 5 out of 5 or 4 out of 5, okay. If 3 of you get the 5 out of 5, then all 3 of you get 0.25 extra to your grade. Okay, I'm serious. Okay, which one looks like a better investment going forward? See, show of hands if for the red line. Yeah, okay. So quick. Yeah, show of hands for the black. So, okay. All right. I remember you. Write it down, okay? Just document this. Let me see you write it down so I can check afterwards. Here. Okay, you can see that this is the realized return over this period. This is the annualized standard deviation of the daily return. Okay. Show of hands for the red. Show of hands for the black. Okay. You can discuss with each other, but briefly. Okay. This one has a distinct pattern. Okay, which one do you like more? Black. Show of hands for black. Okay, all right. Show of hands for red. Okay, lots of reds. And this one, you see, this one is like, it has this one leg up, it's taking a breather, and it's ready maybe to go on the next one. This one looks kind of tired, maybe it's gonna go down soon. What do you think? Red? Show of hands for red. Show of hands for black. Okay. And you write it down, yeah? Okay. And this one, any guesses? Show of hands for black. Show of hands for red. Okay. Now, how strongly you guys are feeling about this? Okay. Well, you've been psyched. Okay, you've been psyched. Okay, forget it. There's no quarter point. It's like you guys haven't been listening to me at all. I've been telling you, you can't read off the charts various points in this course that this is a behavioral bias. This whole thing is about behavioral biases. You fell right into it, and you guys are psyched. I'm not too happy about you and you in particular, because I saw you like so brave and macho boys like red or This is not a casino, okay? You treat this like a casino, guess what? The house always wins and you lose. And it's not just that I'm telling you you've been psyched, I'm gonna explain to you how you exactly have been psyched. Also you, I remember you, that you thought this was scientific, you felt finally confident that there is something you can relate to. Up until now it was accounting and boring stuff and logic, but now it's like charts and you can relate to it, so you felt comfortable. I remember you, I saw your faces when you lifted your hands. Don't worry about it. And the point is that this first chart is the actual realized return of MSCI World, like an index of all the stocks in the world. And this is the actual return as it realized during this period. And then every other chart, this one and this one, and this one and this one, even that you seem to have patterns here, they are all random draws of daily returns from a normal distribution. I imposed a normal distribution drawn from this distribution. Okay, so I slice this daily, and then I get daily returns from this, and then I impose normality on that, such that they have 4.9 expected returns over this period, and 13.3 expected standard deviation annualized, and then I draw randomly from a normal IID. You guys know from your statistics classes what IID stands for: independent and identical distribution. Independent. Individual?
Independent, individual. No,
Okay.
I don't know.
Independent and identical. It means that it's drawn from the same distribution, but it's independent from the previous draws. So if I take another draw from this distribution, it's the same distribution, but it has nothing to do with the previous distribution. So they're not correlated, for sure not correlated. And so I draw these daily returns, and then I accumulate them, and that's the chart. Here, and here, and here. So all these charts have the same expected return, same expected standard deviation, but absolutely IID. Every daily return is mechanically, I've imposed to be uncorrelated. And therefore, what has happened has absolutely no meaning what will happen, okay? Except that this is the annualized standard deviation, and this is the expected return. Okay? So the point of this drill is that even I know for a fact there is no predictability except the 4.9 expected return, you still saw patterns here that felt strongly about black or red, just like in the casino. Okay? Take this with you. Technical analysis is one of the most powerful behavioral biases. Even after years of experience, it's damn near impossible to shake it off. Okay? Yeah.
But wouldn't it be that?
But isn't it actually? But doesn't it actually
but,
work?
But I mean, supposing that that the thing it does a random walk. So when you choose, it doesn't actually matter which one you choose.
That's the point.
So you can just say, like, it actually is like the casino. So you take either red or black, and the chance is 50% it goes down.
That's true, but you guys have stopped to think, and you chose one or the other.
Yeah.
If you had realized that they are equivalent, you would say, Avi, I'm raising both hands, or I'm not raising, or I'm at least making a face to indicate that I know it's a hoax. But no, you took it very seriously, like there's a quarter point in it for you. And you thought that this was right and wrong. Okay, that's why you're psyched. Another question? Okay, no chance for retail investor to be successful at stock picking and market timing. It's been shown by many studies and real life experience that there can be no outperformance on average across all of retail investors or even institutional investors. And they can be, because they add up to the market, right? So on aggregate, they are the market, so on aggregate, they cannot beat the market. And especially retail investors do worse than the market because of these behavioral biases. There is no outperformance for any one retail investor or even any one investor. You could talk about Warren Buffett, but never mind, because you can't really prove it. But what you can definitely show that there is no one retail investor that on average over a long enough period of time beats the market, beats this 4.9. In this example, that's the trend of the random walk. It's a random walk over a trend. Okay, so it's going up, but above and beyond, above or below the trend, that's the random walk. And ton of evidence that active mutual funds and hedge fund managers underperform on average the market by their excessive fees. Okay? I cannot and I will not reproduce all of this evidence because that's just not possible. People get Nobel Prizes for this and it's lifetime work of many people. Take my word for it. Okay? What is the right thing to do? Okay, I've told you what's the wrong thing to do is to gamble based on a chart, based on your intuition. Why would you have such strong intuition to begin with about stocks going up and down? It's a random chart. Why would you feel so strongly about it? It's a behavioral bias. Don't feel bad about it. That's how I started at age 13. That's when I started looking at charts, and I thought for years, I spent years of my life thinking the charts are predictable. Really, to a scientific level, I try to predict them, and they are unpredictable. And this illustrates it. This doesn't prove it, but it illustrates when they are factually unpredictable, and then you seem to think that there are patterns. What's the practical theory? The only theory that we're going to discuss is that markets are roughly efficient. Okay, so that means the prices roughly reflect the values of the underlying assets. And it's impossible to tell when they deviate from values and when they will revert back. Okay, maybe you can say that Bitcoin at 20,000 was an overvaluation, but you don't know when it's going to come back to 3,000. Okay, especially for public securities. Public securities are securities that trade on exchanges. These are the ones that you see having charts, okay? These are the ones that everyone already knows about, that so many people have worked hard to make them public, to advertise a prospectus, and to publish quarterly financial results, and to reach out to all the institutional investors to promote this, and people have heard about this. Lots of people have touched it and know about it and are informed about it. Especially public securities are roughly efficient. The prices of them trading in the market is roughly equal to what their value should be based on their cash flows, their dividends, and future expected price appreciation. And the conclusion is passive investing. Okay, passive investing means don't choose stocks, don't time the market, and get diversified over pretty much everything out there. Get the index fund that buys all of the stocks out there in the world, get a few funds that cover most of the different bond markets out there, and you're pretty much good to go. You remember from last class I showed you those long-term charts? You can recreate that pretty easily nowadays with a few funds and just ride it out up and down, and over 20 years you'll make money for sure. Okay? Yeah.
So what do day traders at banks look for when they try to do?
Oh, we'll get there, we'll get there. So day trading does not take place in banks. Banks don't do that. You don't have people gambling up and down with bank money. You don't have that because they've been fired long ago because they lose money. Okay? And that's a big behavioral bias. We get there, day trading, and that's definitely on the list. Yeah.
But how would you know that the trends continue like that? It's also historically that
Okay, why is the trend positive? Why are expected returns positive? Okay, this we discussed, you remember, in the equities lecture about equities. So you can go to the last slide on equities. We discussed why expected returns are positive. And I didn't give you any mathematical or theoretical proof, but I just discussed with you the logic of, and I don't want to repeat that because it takes some time, but just go back to that. So this is the one kind of theoretical conclusion that I gave you. I tried to convince you, but it's impossible to prove it, but it's quite simple logic that expected returns are positive. So if I'm going to give you a loan, it's going to be at a positive interest rate, right? I'm not going to give you a loan unless I have some sort of mechanism to make money off of it and to make sure that the money returns, right? Otherwise I wouldn't give it to you. So this act of financing must have logically, rationally, a positive expected return for me. Otherwise I just keep the money or spend the money. Okay, and because buying stocks from a company for the first time is financing this company, and I wouldn't finance this company unless there was an expected positive gain from this. Okay, that's the logic. Think about it. Because people wouldn't finance if they were going to finance at a loss. But it can be, so that's the difference between ex ante and ex post. Ex ante, there's a positive expected return, and that's why over time you see it going up, because it's kind of averaging out all the bad and good periods. But ex post, it can be that I financed you, but I made a mistake and you didn't pay me back, and now and I took a loss. It can be ex post that I made a mistake, but ex ante, if I gave you the loan, that's probably was not a mistake, because I knew that I'd take you to court or anything. Okay, what's the correct portfolio? Okay, the rational recipe is to think about it, internalize that expected returns are positive. Okay, look at the long-term charts, think about this logical argumentation that I just made, that and understand that expected returns are positive, but that you cannot predict which one is going to give such a better return. Okay, then you want to, and that you don't have any private information. You don't know that Apple is going to be so successful when it was in its beginning, because you don't have any way to know that, more so than what the others already know. You don't have any private information, you don't have any crystal ball, and you need to get a diversified portfolio. You need to avoid timing the market, you need to avoid stock picking, and you need to control your costs. Okay? Because you can always pay 2-3% per year for some fancy strategy, and that's not going to produce you anything more than what you can get just by passive investing. And not only that, the question is how much to invest of your cash. Okay? Now, go back to what is cash. Now you know, this is already a huge value that I've provided to you, because most people don't know what cash is. I'm talking about people who have been governors of central banks, all right? The highest economists you can imagine, they don't know the basic accounting facts of money that I've taught you, and they don't understand that money is a loan. Even cash is a loan to the central bank, and that the central bank rolls this over to assets and makes a spread, makes a profit. I've shown you the profits of the Federal Reserve. They've been positive since forever, including the time of the recession. You remember that lecture? And so, anyways, cash is a loan that gives you zero. You might as well invest all of your cash. So the recipe is invest all of your excess cash and liquidate assets, sell your assets when you need the cash to spend. Okay? That's the rational recipe. Okay? You don't have to follow the rational recipe, but this is the rational recipe. If you follow this, you can retire by age 40 or less. Okay? It's possible. I've done it. So invest all your excess cash, only sell when you need to finance expenditure, and get a very widely diversified portfolio. Don't time the market in and out, don't choose single stocks, and don't chase fads, and don't do all these behavioral biases that we're gonna go over some. You're gonna like it. You're gonna love this. This is gonna challenge you, and you're gonna like it. Any more questions at this stage? Okay. I'm gonna throw in a brain twister there. Discuss what someone has coined as an equilibrium level of disequilibrium. Okay? I told you just now, don't watch the news. Don't follow Tesla or Apple or Bitcoin so closely, because anyways you don't know anything about Apple that the market doesn't already know. So, because if everyone was a passive investor, okay, and just buying the market, never looking at the news, then anyone, you or me, could realize that Apple shares are a bargain at $1 per share, because Apple is selling so many iPhones, is making, I don't know, maybe $10 per share profit. Then it shouldn't be trading at $1 per share, and then we could make a lot of money. But of course, people do pay attention closely, and then they bid up the price of the shares to maybe $100 per share or more, such that $10 per share profit, I don't know if they make $10 per share, makes sense, more or less. Okay, so and then that people watch it so closely negate the need for you to watch it. Okay, so on the one hand, I'm telling you don't watch the news. On the other hand, I'm telling you watch the news, because people watching financial news and realizing that Apple is making so many profits, selling so many iPhones, is what makes prices efficient. Okay, that's what brought the price of Apple from $1 per share to $100 per share. Because people do pay attention, people do notice when these things happen, when they sell a lot of iPhones, okay? And there must be a profit, rationality again, there must be a profit in it for these people to gather the information, to think about it, and to take risk based on this. Okay? So that's the equilibrium level of this equilibrium. There's just enough excessively profitable trades out there to justify the cost of the most sophisticated active investors. Okay? So if I really have some special intelligence gathering mechanism and I can find out which stocks are undervalued, then okay, it took me a long time and a lot of money to invest in this kind of, there's an arms race to build up this capability, and then I'm making the profit off that. But if you don't have even like a basic web crawler to find this information, or I don't know, whatever technique, that doesn't work anyways. If you don't even have anywhere near that capability to gather information like I do, because I have not me in particular, but let's say people have like large scale information gathering, processing, all these algorithms. If you don't, then they're going to make the profits and you might as well just buy the market. Okay, so there's just enough excessively profitable opportunities out there to justify the most well-informed traders to make money. Now, I don't want you to think that the direction is to have more sophisticated algorithms. That's probably not the case. But people closer to the companies, you know, people who live right where these companies operate, people who have some sort of inside information or some sort of expertise in this market, people who are in a related industry and all of a sudden see a lot of coming out from this company. So these people are closer to the actual business activity than you just looking at your laptop, reading someone else's article on Bloomberg. Okay? So it's various people, so it's kind of a local thing that makes prices efficient. So I would be very well informed about one segment of the market because I'm always involved in it, not just reading about it, but I'm actually involved in it. I see the flows of capital going from one thing to another. I see what people are buying, what people are selling. But I wouldn't be so well informed about this other thing. But there would be people closer to that plate who would buy and sell because they're better informed to make prices of that asset efficient. And I'll make prices of this asset efficient. okay? And then if you are just equipped with an iPad, you might as well just buy a little bit of me, a little bit of the asset that I'm following closely, a little bit of the asset that he's following closely. But you shouldn't try to buy and sell like I do, so because I'm much better informed than you as regards this asset, okay? And this being better informed is not really about high frequency stuff. Don't even go there. I mean, you don't need to be so clever about it. These things, mostly they don't work, okay? Inconsistent winners. It's not clear that it's possible for the same person or entity to consistently beat the market. It seems like active investors take turns at making excessive profits, followed by excessive losses. The result is efficient markets, but subpar performance to most active investors. Okay, so all these active mutual funds that have analysts that are highly paid to choose stocks, and they do the analysis, then on average all of them produce subpar performance because they take excessive fees, but somehow the prices of assets, if you just buy the passive fund, is mostly efficient. Okay, it's a mix out there. It's not logically inconsistent. Think about it, and what's written here is logically consistent. Consistent winners, you do have high frequency traders out there making consistently excessive returns, but I don't want to talk too much about it, just to tell you that this is about infrastructure. What you hear about high frequency trading making so many profits, this is not what you learn in your other classes about their return distribution and predictive regressions. It's really not about that. It doesn't even work at that frequency. High frequency trading is really very, very simple strategies. It's not even a strategy. It means buy the future, sell the stocks. Okay, it's basically the same asset that trades one in Chicago, one in New York. Okay, and they would build the fastest IT systems to see the little differences and trade based on this. So you don't need theory or economic theory on how things are correlated to figure it out. You just need very good information technology. And that's they make profits very steadily with very little capital. Okay, but they're in a constant race, and there's huge barriers to entry. And this is anyways, they're not interested in economists or even financiers or even accountants. They're interested in computer scientists and physicists. And long-term investors, these people are consistent winners. Okay, you remember that chart that keeps going up and up and up? Anyone, sovereign wealth funds, look at their portfolios. Look at the portfolios of each of these. Sovereign wealth funds, pension plans, university endowments. They have exactly the portfolio that I'm telling you. They have a basket of all the stocks in the world, a basket of most of the bonds in the world. They hedge the currency as is required by their constituency, but on their liability side. And the real estate, all types of loans, private equity investment, they buy and hold. They finance individuals and companies and wait for the money to come back. They have in place the mechanisms to take the money back, okay? It's not really up to them. They just buy securities. They don't go too much into private assets, private markets. So they just buy securities. And securities already have in place the bond trustee, okay? It's already in place what will happen if the company defaults. So there is already a mechanism to get back the money plus interest. So they, and individuals, I mean, it's up to you. If you just buy the ETFs and wait, you will make money in the long term. I mean, it's not gonna be doubling and doubling and doubling your money every year like you hoped, but you're gonna make your 5, 6, 7% per year. And you buy and hold, and that consistently works through the beginning of time, okay, of humanity, all right? It's always worked. So why am I telling you all about all these biases? I'm about to tell you all these biases, is because you'll encounter them, these biases in storytelling in each and every person you meet, okay? And in yourselves. And honestly, the best thing for you is to train yourself to exploit these biases in others, but I was never able to to do. So maybe I'm doing you a disfavor by showing you all of these, because once you become aware of all these fallacies, it's harder to repeat them. It's harder to tell them to someone even less informed than you that this happened, some storytelling that's not true. It's harder to lie after you know the truth. So maybe I'm doing you a disfavor, but then that's why some of the best salespeople and economists out there, they spend their entire careers not knowing the very basic mechanics of the stuff that they're selling or commenting on. But of course, that's my subjective opinion. You can have another opinion. But also, when you get into banks or other places, you're going to see that there's dominant personality types coming into the room full of analysts. Maybe they're at the same level, and they just dominate the others by very fast and aggressively saying all these biases that I'm going to tell you about technical analysis or other types of stuff. Not so much about technical analysis, because that's kind of widely debunked. Nobody talks about technical analysis because everyone knows that this is widely debunked. But they would say some smart sounding nonsense and very aggressively and faster than you can answer back. And next thing you know, next year they're managing the team. Okay, because of behavioral bias at the group level. Okay, so you're gonna see this. I don't want you to get surprised. People realize, and then the other point is people realize that all this economic prediction and smart sounding nonsense. People realize that this is just nonsense. Okay, not everyone, and everyone believes it in one way or another. But at the end, people know that it doesn't work, and you should think whether you want this career path for yourself to be kind of an analyst of something, of the economy. And I don't think that's a profession. Okay, this is my opinion. You feel free to disagree with me, but being an analyst of the economy, I don't think that's an actual profession. It's just like one level, because it's just like journalism. It's just giving opinions about something that's really, nobody really can say anything at that level. But it's up to you, what you want to do. Okay, private banking, and most people give their money away to a professional manager believing that their horse is the winner, or at least it will not rob them. It's a very personal thing. People choose their private banker. It's almost like choosing a spouse. Could be extremely irrational. Fees in the industry are persistently fantastically high. People tell all the time, complain that the fees are coming down, the wages are not what they used to be. That's nonsense. I mean, yeah, it's still fantastic for the right people. And even regular salespeople, if you want to be a secretary, if you want to be a salesperson, you might as well do this in finance because you get twice as paid. And the reliance on personal or professional salespeople is extremely high in this industry. And this is proof, okay, this is indication that these behavioral biases that I'm telling you about, especially inaction bias, okay, is one of the biggest biases out there. The first and biggest bias is inaction. The people don't do anything. If they have cash, then they don't invest. Or if they got by inheritance some business or some stocks that they wouldn't buy on their own accord, but they never sell it. Okay? Inaction bias is by far the biggest bias in humans, and especially as regards finance, and that's why professional salespeople, the use of them is very high, because people need to be convinced into doing anything with their money. Okay? I'm sure you guys can imagine. Clients are biased. Okay? It takes long emotional persuasion for them to do anything. So wealth management divisions, so this lecture is still about wealth management division. It still needs fantastic stories told by fantastic salespeople and analysts. Okay, you need that. So the jobs in wealth management, and a lot of people go into wealth management. You might want to consider getting an actual profession, like something like, I don't know, accounting or an accountant or a lawyer or a doctor, a medical doctor. These are actual kind of, with barriers to entry. but if you just become an analyst, then okay, then anyone can become an analyst, and that leaves you kind of in a place where you have a lot of competition. Then it's up to you. Then you're in the jungle, okay? And then it's the law of the jungle. This is how dominant you are, how manipulative you are, how socially clever you are. That's how. Okay, the client advisor. That's the heart of private banking. Okay, the client advisors are valued by the clients and the bank. Okay, they are the face of the bank towards the client. They care to the client's every need, and they're the ones bringing the clients to the bank. Sometimes, many times, most clients they come to the bank because of the bank's reputation. Then it's one of the oldest professions. It's a very Swiss profession. Okay, the profession is appreciated by almost everyone inside the bank. Okay, it's not an easy profession. We discussed. Very kind of psychologically intense. On the other profession you have in wealth management is an economist or an analyst. Okay, they're much less respected in the bank and much less well paid. Although still well paid relative to what they're actually value they're creating, which I argue is zero. Because, okay, that's my cynical opinion. They don't have access to the clients. Okay, that's why they're not respected by the other parts of the bank. Okay, if you're sitting in the research department, in the CIO, Chief Investment Office, and you're making an analysis about the macroeconomy or about this sector or this other sector, then you're kind of talking to yourself. Where are your clients? Oh, you don't have clients? Why should I even talk to you? Okay, where is the money? Okay, oh, you don't have any money that you direct here or there? Why should I talk to you? Okay, so they are much less respected, and you make your own opinion from your experience. They're a cost center, okay? All this analysis we discussed in the previous lecture is part of the marketing kind of effort, okay? So that's the behavioral bias of the clients, that they want their horse to be a winner. They chose this bank or that bank to manage their money, and they want to see that there's a constant research stream coming out of the research department of this bank, so they feel that the bank is doing work for them and is monitoring whatever, okay, and making opinions about this industry or that industry. So this what brings the clients, and this what clients want to see. But this is a behavioral bias, because even that you think, even that I discussed that yes, you need analysis and you need active investors to make prices efficient, these analysts in the banks and analysts anywhere, they just read from their computers about what's in Bloomberg, or make even much more complicated analysis, that it's never valuable. It's never really valuable. That's pretty much factual. I mean, you're gonna see for yourself. But there's hundreds of pages daily being produced of research and publications from these departments about anything, you name it. Gold, oil, Apple, anything, you name it. US stocks, European stocks, bonds, credit spreads, anything. Wow, you can drown in this your entire careers. And if you don't, look at the bigger picture, that none of this leads you to making any better return than the few ETFs and the few funds that you chose in your pension plan and just let it go. Following these analysis of theirs doesn't get you any better than that. In fact, it gets you much worse. And then you might drown yourself in all of this. Okay? And then, even more than that, and this is very subjective opinion here, okay? Feel free to communicate on this. It's my observation that in the banks and in business in general, when economists, especially with this, we say economist, it's a derogatory term, okay? It's a code word for someone that has very strong opinions about things that he doesn't really have any control or any private information over, but feels very, very strongly about the US economy versus the European economy, or almost like someone that's so politically left or so politically right that you can't stand him, that every time he brings these topics up, and it's the same thing. Okay, an economist can be a derogatory term for someone that is so stubborn that he's at the same time he doesn't even invest, he doesn't even have the authority to invest other people's money. At the same time he doesn't even invest his own money, but he makes such strong predictions about certain things, oil or gold, which he has no private information over. And then the few actual business people out there, they would say, well, he's an economist, like as soon as he walks in the room, because maybe you're a businessman and we're trying to have something, but maybe you don't know him, but I know him, then I said he's an economist, and then you'll ignore him too. Okay? So economist this is a very subjective. Don't be offended if you're going to be an economist, but this is an observation, subjective observation of mine, that economist can be a derogatory term in business. But yeah, plenty of actual jobs. A client advisor, okay, if you accept that your job is to be with the client and whatever he needs, then that's your job. That's the job in a wealth management division. So we started late, so I'm taking all of your break. Okay? You can have a break. If you need a break, you can have a break. But I'm staying. Credit officers, traders, accountants, legal advisors, compliance officers, okay? These are actual jobs. People are actually doing work. There's lots of politics and nonsense goes on, and if this is your job too, right? But that's just corporate life. But these are actual jobs, and this is the job. But this you gotta be careful. You gotta, because people walk into this. People run into this thinking it's science and they're going to actually do something and make predictions and this is going to help people. But yeah, they end up being economists. Alright, keeping on with the behavioral biases. If you guys need a break, you can take a break and come back when you want. First and foremost is, I told you, the inaction bias. The second is the illusion of predictability. The illusion of predictability, it seems that people think that assets are predictable in the shorter term to a much higher extent that they really are. Assets are not nearly as present, not nearly as predictable as people think they are. Generically saying, 99 people, the investors believe they have a higher predictive power than a mere random walk around a trend, but this cannot be true, okay, because on aggregate, we own the market, all of us, then how can it be that 99% of us think that we're beating the market or that we will beat the market? People know that they haven't beat the market because they lost money, but even they don't realize that they've lost money over time because they lie to themselves, because they never really plot their actual return. They just keep in mind what they've made here and what they've made there. They even lie to themselves, not even remembering correctly how much they made and how much they lost their entire careers in gambling in the markets. The laws of physics. The belief that asset prices abide by the laws of Newtonian physics. Oh my God, this is a very powerful one. This relates to the technical analysis. This goes one-on-one with the technical analysis. So people think that if the prices are high, they have potential energy to go down, to be converted into kinetic energy to go down. People think that if prices have just started coming down from the top, they have momentum to continue coming down, or if they're going up and up and up, they have momentum to continue going higher. And if prices went down a lot, then they will hit the floor and bounce back like a ball. People feel very strongly that this is about to happen, and you can't shake it off. Even I feel like this many times, and I cannot shake it off. But I shake it off because it's a matter of training. Okay, there's nobody on the planet that's immune to this. That said, so asset prices do not need to correct downwards or upwards. This word correction, oh, a correction has started. But this whole word is misguided. because they went up, now they're going down, or because they went down, now they're going up, so it's a correction. This whole word is biased. And prices don't need to correct downwards or upwards. Okay? Prices of assets are the result of bids and asks that people put in, and the reason why they put bids and asks is a million reasons, and the result is not Newtonian physics. Yeah.
Isn't it if enough people think that after 1,000% in one day it has to go down, if enough people think that, they will go down because you start selling it, right?
Yeah, but people won't bid it up to plus 1,000% because people are not so gullible with their money. People are not just gonna buy stuff that's just gonna go through the roof.
Or fear on the market. As soon as it starts going down, people fear sell, and then it will go down a little bit more, right?
There's the difference between ex ante and ex post. Okay, I want to talk to you about a bit about the ex ante and ex post. And this is the biggest problem. What you're referring to, this is the biggest difficulty in convincing people to let go of these biases. Is that I can never prove you wrong, because you will always find an example of something that went up so much, and ex post, in hindsight, it was clear that it was gonna go down after it went up so much. And similarly, if it went down so much, then ex post, you will say, but didn't this go down so much it was a good buying opportunity? And Avi, why do you tell me these things? And that's the greatest difficulty in convincing you that that you were ex ante wrong. Okay, you were ex ante wrong to buy a single stock or something that went down just because it went down, or sell something that it went up just because it went up. You were ex ante wrong because it was the wrong strategy, because it deviated from this recipe that I gave you that was a rational recipe. You deviated from that, so you made an ex ante mistake. But ex post, after it went up or down, after you bought or sold, then maybe you were right. So you can always be right ex post. And that makes it difficult for me to prove that you are ex ante wrong. You can be ex ante wrong and ex post right. So that's why it's so difficult. But the sooner you let go of these and move on to actual business practice, then it'll benefit you. Okay, that said, you do have some of these. You can read about this for the need to sell, take profits. Okay, this is another behavioral bias, that people think they need to sell before they actually need the cash. Okay, people think that they have this symmetrical thinking that they bought for some reason, usually a biased reason, but then at some point they also need to sell. They need to have a plan when they will sell. And this sort of symmetrical thinking is also biased. There's two biases. One is you bought for the wrong reason, and now you're selling for the wrong reason. You don't need to sell. If you have a widely diversified portfolio of assets, and you have a job, and you're saving every month, then you don't need to sell. You only need to sell when you need to buy a house or a car, or you are retiring. That's the rational recipe. Okay? So this bias is strong, especially when gambling in single stocks. So you bought for some biased reason, tip from a friend, or chasing a fad, and then you think you need to sell or take profits because it went up, and so on. So it's two biases. Okay, so selling your single stocks is the right thing to do, but to correct the error of buying them to begin with. Okay, so if you bought some single stocks because of a tip from a friend, or because of chasing some fad, or because technical analysis, then selling them is the right thing to do, but not because you need to sell them because you need to take profit, because you need to correct the error of buying them to begin with. Okay. So sometimes two biases make it right, but many times two biases don't make it right. Okay, trading too much. Okay, so the above and many other biases lead to trading way too much. And this you actually see. So there's quite a bit of evidence out there that it's very hard to explain why people trade so much as much as they do. And it's obvious that, to me, that this is related, that this is the manifestation of people's biases. Up, down, up, down, up, down, buy, sell, get dizzy, lose money, lie to yourself about how much money you actually lost and what life means, move on, and complain to your peers how hard it is to make money in this market, as if this market or Trump or something that's in the news made it harder for you to make money by gambling up and down on single stocks or other things that you shouldn't be doing. You see that a lot of times. People trade way too much up and down because of these biases. The single stock bias is a huge bias out there, that people are under diversified. They believe that their chosen stocks are better than a diversified portfolio. They think they're smarter than everyone else. They think that it's related to also to the control bias. Okay, people won't buy a diversified fund that invests in all the world stocks because they feel, wow, I can never know all the companies that I'm investing in. There's like 10,000 companies in this fund. I can never know all these companies, but I'm a control freak. I want to know each and everything that I invest in. Then I'm not going to get diversified. I'm just going to read a lot about Apple and Tesla and Bitcoin and buy these three things. Okay, and so the single stock bias and the fads is related to the control bias, that people don't feel that they can control. I feel there's lots of emotions coming from some people that disagree with me. They have some sort of cognitive dissonance. Be easy, just take it in, and you can think later if I'm right or wrong. Okay, I'm right. Okay, I'm very right about these behavioral biases. Just take it in. Don't fight yourself. Don't fight me. Think about it later. Okay. Then they won't admit the mistake, and then they don't have to sell. So they don't have to sell their speculative stock. They're kind of stubborn. And then when they lose money because they bought something very risky that they shouldn't have had, then they say, oh, or even before they sell, someone would tell them, listen, are you sure you want to put half of your money in one stock that it's very risky stock that you think you know something about but you really don't? Do you really want to do that? What if you lose the money? Don't you want to get a diversified portfolio? And they say, oh, life is not about optimizing my portfolio so much. Then it doesn't really matter if I have such an optimized portfolio or a very concentrated portfolio. But that's true. Life is more about that. But it's also true that life is more about other things than it is about gambling in single stocks. Okay, that's also true. Cash hoarding. Okay, we discussed. So hold too much cash for way too long. But read the financial news every day and nag people with your opinions about what's going to happen with the economy and with politics and with the markets, but you never invest your money. So why do you even read the news? Why, especially why do you nag us? Okay. Staying out of markets. So the chronic cash hoarder, if prices went up, would say assets are expensive now. If prices went down, cash hoarder would say assets are risky now. If prices are unchanged recently, cash hoarder would say, well, they're not moving anywhere, so what's the point? Okay? They would always say these three things, one of these three things, to justify them not doing anything. And because they don't know the basic accounting facts of money, then they don't understand that they're lending the money to the bank and that the bank make constant profits with very basic financing activities by lending it as mortgages or other loans. So they're missing out. But the efficient market hypothesis, okay, trust me, decades of work and several Nobel Prize winners. Okay, you know Eugene Fama, he got a Nobel Prize for the efficient market hypothesis, for testing it. He was my thesis advisor, okay? And he is right. On some things, okay, on this concept of equilibrium level of disequilibrium, the prices are efficient because a lot of people watch them and buy and sell to make them efficient, then he's right about it. And the rational conclusion is that if prices went up, you should stay invested because prices remain fair after they went up and are priced to provide a positive rate of expected return going forward, even if they just went up. Okay, and similarly, if they just went down, they are still fairly priced after they went down, and maybe they went down because some new information came, or maybe not because of some new information came, but you should assume, it's best for you to assume that prices are still efficient and still reflective of values and still priced to provide a positive expected return going forward, because it's logical that if I'm buying shares of Apple, and Apple can always come in the market and sell new shares, and I'm not going to be willing to pay more for the existing shares than for the new shares because it's the same asset, and then this is a financing activity between me and this company, and I'm not going to give money away, take risk, and postpone consumption if there wasn't a positive expected return in it for me. It's just logical, and the result of this is that actual returns on average, if you plot them over a long enough period of time, the actual returns are positive. Because expected returns at any point in time are positive. And think about it. Underestimating compound interest. Why bother investing when expected returns are only 3 or 4 or 5%? Why should I even bother? The fees will eat it up. And that's true, they might. Okay, if you only have access, because you're lazy, if you only have access to markets via your bank, and you cannot open a Swiss quote account or Interactive Brokers account and get direct access, more direct access and cheaper, then the bank fees can eat up 2%. 2% per year they can eat up, just the bank fees. But the fact is, and this we skipped because we didn't do it this year, that 3 or 5% compound return, this is the Excel spreadsheet that you were supposed to do in groups, but I told you because it's a bit too complicated and I want to make things easier. I didn't have the time, we didn't do it. But the point is that even 3% per year over your entire lifespan from age 24 or 5 when you start to make money until you die, then it makes a huge difference. Okay, even 3% increase from instead of making 0.5% because all your only investments are through your pension plan and you never invest your private wealth. The difference between, say, 0.5% and 3.5%, because you invest all your private wealth, is maybe 12 or 15 years that you can retire earlier. Okay? It's huge. You wouldn't waste 12, 15 years, right? You can barely even spare 15 minutes of your break with me, right? So, 15 years to work. And I'm telling you, working is worse than being a student. Okay, especially if you want to be competitive about it, you go into competition, people feel very strongly that they deserve the money more than you, okay? And it's not like you're gonna study harder because you deserve the 6th grade more than the other. That's fine, you can study on your own. But when it comes to promotion, then you can do things to the other person or say things about the other person to make your chances become a reality. Okay, that's the difference. That's why it becomes much more competitive and unfriendly. It can be. There's some, depends on people's characters. Okay, there's some people that just say okay to everything and they survive. That's why there's no wolves in these corporations. There's only sheep. There's the sheep and there's the lying sheep that control them. But also the lying sheep are sheep. If you face them one-to-one, they'll do what you say. Okay, bought low, another bias. Gambled a small amount in something speculative. So let's say you bought Bitcoin at $10, $10 per Bitcoin. Turned out wildly successful. Okay, now Bitcoin is at 10,000. Many people think it's rational to keep your position because you bought it at 10. What do you care if now if it goes from 10,000 back down to 8,000? You bought it at 10. You still have a massive profit. People think that it's rational to keep it because you bought it so low. You heard this? You ever heard this? You feel this logic can be true? I see, Mark. I know how you're thinking because it's typical thinking, Mark. It's a lot of people. It depends also how you were brought up. So some people, they think that their set of beliefs is so individual, but it could be cultural. It could be cultural. There's many of these biases are cultural. You see them more often in some cultures than in others. Like some cultures think that they're so smarter than the others, and some others think that if they're gonna be conservative in a certain way, then they'll do well. There's two kind of separate cultures. But it's not logical, because if you had an equal amount of cash, I don't know, now your $100,000, your $1,000 that you've invested turned into $1 million. Okay, if you had $1 million now cash, you would never buy it all into Bitcoin at 10,000, would you? Right? Of course you wouldn't. So that's why it's not logical. You have to. So let's do this. Ask yourself, does your portfolio make sense at any point in time? Forget what was yesterday. Today. Does your portfolio make sense today? Tomorrow you wake up. Does your portfolio make sense today? If you had cash, if you sold all your portfolio this morning and got the cash, will you buy now the same exact portfolio? Because that's the portfolio that makes sense going forward. If the answer is yes, then you have the right portfolio. If the answer is no, then you need to rebalance. So Bitcoin, when it was at $10, okay, maybe you can put 1 or 5% of your wealth in a speculative asset, which you seem to know more about than others. Okay, it was at the time, you know, I felt strongly, other people felt strongly that this thing is gonna become massive, and we know about it and others don't. So maybe I was wrong also then, ex ante, to gamble on it, but I did, and not at $10, but at $300. So yeah, but I didn't put all my wealth in it, didn't put half my wealth in it. So maybe it was rational at the time for me to invest for 1 to 5% of my wealth in such a speculative asset such as Bitcoin. Then it goes up to 250. And then it's harder to justify now that something so speculative like Bitcoin would be 50% of my wealth. Because if my entire wealth is $1 million, I'm not going to put 500,000 of it in Bitcoin. But if you look at my wealth right now, half of it, 500,000, is in Bitcoin. Okay? So at 250, it's already very hard to justify that 50% of my wealth is locked up in this crazy thing. And Bitcoin at $10,000, no, there's no way on earth that, I know people that their wealth has gone from, I don't know, a few millions to the 300, 400 million because of this. Okay, very early adopters, people who were rich before that, who got very strong. And then they didn't sell not a single Bitcoin until now. Even now, they didn't sell. So they wrote it all out. But they are, for sure, have been irrational, because at 20,000 or 10,000, they were worth 300 million, and 99.999% of their wealth was in Bitcoin. If you woke up this morning and find out you have $100 million in your bank, would you buy with practically all of it Bitcoin? No. So if you wake up in the morning and have $100 million worth of Bitcoin, then you should have sold some. It's not because you thought it's gonna go down, but because it was illogical to take something so risky and have 100% of your wealth in it. Okay, so that's the bought low bias. Very, very powerful bias. And these two what should guide you. These two are what guides me when I manage my wealth and my clients' wealth. Okay, this is very good tool. Ask yourself, whatever happened yesterday, many things were unexpected that happened yesterday. Maybe some of them took me by surprise. Maybe some of them made me feel bad about my performance. Okay? Maybe I'm questioning everything now. But that was yesterday. Today, is my portfolio logical going forward? If I had everything in cash now at the market price, would I buy the same portfolio or would I buy another portfolio? Okay, so that portfolio you would buy right now if you had everything anyways in cash, that's the right portfolio you should have. Any questions so far? Okay. You guys enjoying this with the program? Okay. Getting sold on a product by salespeople. Okay, we discussed this. Salespeople are more respected in the bank than farmers. Okay, there's hunters versus farmers. Is this discussion? Are you a hunter or you're a farmer? If someone asks you in an interview, are you a hunter or you're a farmer? Don't answer farmer. Okay, you're a hunter. All right, nobody needs farmers. Okay, farmers is code word for an economist. Okay, an analyst that has that if you give him money, then he will choose for you. But what does he know? Nothing. He just sits in front of the laptop and has opinions about stuff that he read from other people's opinions. Okay, and nobody needs farmers. Okay, everybody needs hunters. Okay, you can go and convince people to get me money. I'll pay you more than you can imagine, because salespeople, if they're good hunters, they make money. Okay, nobody needs farmers, unless you're actually doing work. Okay, unless you're an accountant or an actual lawyer, or you coded some software that's useful. That's not a farmer. That's an actual profession. But we're talking in the realm of analysts, economists, bankers, then when they don't really have an actual profession like accounting, legal, doctor, medicine, okay, it's not an actual profession, then you divide them into hunters and farmers, okay? And then the farmers, they don't do so well and they suffer a lot of stress. Hunters also are a lot of stress, but at least they're in their element and at least they're valued by the bank because they're bringing in money, okay? And they are the face to the clients. Okay, watch Glengarry Glen Ross. Alec Baldwin famously explains ABC. Always be closing. Okay, always be closing. This is good. It's a good movie. Watch it. Tip from a friend: leverage day trading. Okay, you asked me about leverage day trading. This is not done in banks. Okay, banks are not in the business of losing money. Okay, banks are kind of adult institutions. They don't just let people gamble with the bank's money and not with the client's money in this way either. They would let them choose this industry over that industry because this is what the clients kind of want, for them to produce research and be active investors, but not buy and sell so quickly, because that clearly loses money. That so clearly loses money that this has been pushed out from actual and financial institutions. Okay, people who sit at home and they trade in between jobs, yeah, that's a sad life. Walk up to your friend who lost his job and ask him what he's doing. Oh, I'm day trading. I'm trying to make a business from my day trading. And you're looking at a friend who has the same as a drug problem, has a gambling problem. Okay, either you help them or you don't. Sometimes it's hard to help these people until they lose the money. It's usually they buy and sell several times a day, every day, based on nothing but intuition and imagined patterns in a chart. Okay, how can you know what will go up if the DAX or the S&P will go up or down in the next 5, 10, 20 minutes based on a chart? It's complete bogus. But there's millions of people out there practicing this non-profession and lose their money every day. And you would find if you Google CFDs, then you would find also binary options. There's lots of stuff out there to encourage people to do that, even not directly in the financial markets, but kind of there would be a broker in between that would make sure that you're also losing money. Stay away from binary options, stay away from CFDs, stay away from leveraged forex trading, because you lose your money from day one. Chasing fads, okay? Chasing pseudo fads. Pseudo fads you will find, if you start looking into it and you don't have the background that I gave you, but you do have the inclination to be scientific, then you will find these pseudo articles online about gold, why gold is over the years and blah 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 gold, and that's why that's the only thing you should, and the world's going to collapse and you should buy gold. And similarly about rare minerals, you wouldn't even believe it, but there's these niche pseudo-scientific scams. They're not really scams because they charge you just like $25 for the newsletter or something, and then they recommend that you buy these set of stocks, so they don't really make money from you actually buying them. But you will find people strongly believe that you should buy stocks of companies making these weird kind of rare minerals. Water. This is a huge bias. This is not as big as gold, but there's a pretty big bias. You have funds out there that do water. What's a water fund? It's a water fund. What's a water fund? Water is something that people always need, right? So invest in stocks of companies that do water stuff. Okay? Either water treatment or handheld devices to purify water. As if this is gonna be the next thing. Like in Africa, they don't have water, so buy this thing that purifies water. We'll sell this in Africa. And so, pseudoscientific things, so these things, check it out, batteries. Okay? Batteries is also a big thing. Like you would find these pseudoscientific articles pushing people into one of these. There's a few others like this. And they keep coming back, like these things. They've been around since forever. These fads. It's like now is the time to buy water stocks. As if some utility company in Chicago and some company that makes these little gimmicks for in Africa if you don't have clean water, somehow these are correlated. Like the demand for water now is high. I don't know, I drink water every day, so I don't know. Emotional roller coaster. Okay, you buy for the wrong reasons, you get nervous when it goes down, right? You don't get nervous when it goes up. You buy for the wrong reasons, you get nervous when it goes down. Even first it went up. So it could be that you start going down immediately, or maybe gone up a little bit, but then it gone down. So the point is you get nervous after it's gone down. Either now, or when you bought now, then now. You get nervous after it's gone down, and that's when you sell, after you get nervous. Okay, so you always lock in the loss. And that's why people lose money.